So this is lecture video part 1, chapter 15. This is an introduction to managerial accounting concepts. This is what our course is going to be about this semester. The first thing to understand is that managerial accounting is obviously different than financial accounting. Managerial accounting is going to be more focused on understanding the cost structure of the company. Cost structure obviously will then impact profitability. So we're going to be looking at, in fact, a couple of different items. We're going to be looking at product costing, how we're going to determine the cost of a product that we're going to produce, again, in a manufacturing environment. Product costing, in turn, will help us determine how we're going to price the product that we're going to sell. Pricing is has a direct relationship to the cost of the product that we produce. We're also going to be able to understand the number of units that we're going to have to sell of a particular product to generate specific level of profitability or to break even. It's also going to help us understand the degree to which we're producing product efficiently and whether there are cost reduction or cost optimization opportunities. And then, of course, the effect that volume or increased or decreased production has on our cost structure will also be a topic that we're going to discuss later on in the semester. But really, if you think about all these things are going to help us in decision making. So all of these managerial accounting topics are going to help us to make better decisions. And so in the textbook, there's a number of different differences between managerial and financial accounting. But I think the most important ones is that managerial accounting is focused more internally. So we're using this information as a manager's point of view for internal decision making. It's not necessarily published in external financial statements, but it's used internally for decision making to help us run the business better. It's a series of reports, sometimes customized reports, not necessarily GAAP financial statement type reports. They're usually in much more detail than what is disclosed to the public. And again, they're for very specific purposes to help us make decisions to optimize our business, but more specifically from a cost or investment point of view, which will in turn increase the profitability of the company and thereby improve the overall value of the business. So in chapter 15, I think the primary objective really of this chapter is the understanding basically of the cost flow. And again, we're talking about in a manufacturing environment. Okay, so different than a service or a retail business, but in a manufacturing environment, how do the costs work in terms of flowing through the inventory accounts and into cost of goods sold? And so this chapter really sets the groundwork or establishes the groundwork so that we can understand how costs are accumulated in a manufacturing firm. Well, first of all, let's go back and think about from a retail perspective. If we think about inventory, inventory is of course shown on our balance sheet. It's a current asset. And if you think about inventory, usually we'd have some kind of beginning balance. To that, we're adding purchases. And that's going to give us what we at that time had called cost of goods available for sale. And again, I'm just using a T account, so we can kind of keep everything organized and straight. We can see how the costs are flowing through the accounts. And by the way, in these next 4 chapters at least, I'm going to use T accounts pretty heavily. And if you don't understand how T accounts work, I would suggest revisiting that topic because it's going to make things so much easier to visualize how the costs are flowing across the different accounts. Okay, so here we have beginning inventory plus purchases will give us cost of goods available for sale. Now, if you think about it, in inventory, we're either going to, of the costs, total costs available for sale, they're either going to be still in inventory, which means they would then be in the ending inventory, or if they're no longer in ending inventory, that means they're being transferred out as cost of goods sold, and they're going to the income statement. So I think that's obviously, hopefully a review. Pretty simple though. Costs come into inventory, and then when they're sold, they leave inventory, go into cost of goods sold, reflected as an expense on our income statement as cost of goods sold, and then whatever's left over remains as ending inventory on our balance sheet and is reported as such. So unlike a retail business, a manufacturing business, we actually have a number of inventory accounts. And so I've identified, as shown here, 3 different T accounts, each one of them representing a different inventory account. And each one of them really representing a physical inventory location, a different physical inventory location. And I think it's easy to think about it that way because it is actually a physical separation, and it's physically easier to think about how the costs are flowing. So the first thing that happens is in a manufacturing environment, we would need to, if we were building, let's say, as we, in the book, I think the example is guitars. If we're building guitars, the first thing we'd have to do is we'd have to go out and purchase some materials. So the first type of inventory is going to be called materials. And again, this would be shown as an inventory account. Again, on our balance sheet, this would be an inventory account. So we have one inventory account, materials. And if you think about materials, the physical location that we can think about would be materials. We could think about that as being the storeroom. So we're going to have a separate area where we're going to purchase these materials and we're going to put them in a room. It's going to be a storeroom. We're going to have a door, obviously, that's locked. Maybe it has a dock on the back of it. But it's going to be a separate area, and that's where we're going to keep our wood, paints, varnishes, screws, strings, all the things that we need to assemble the guitars. So that would be in the storeroom, and we'll call that materials. Okay, so any purchases would be coming in, and that's the account where those purchases would be held. So we're going to purchase materials. If we did that, we would debit materials inventory, and we'd credit accounts payable. Okay, so not that unlike our retail inventory example up above. Okay, then what happens is we would have another inventory account, and basically this is what we're going to call work in process. Okay, I'm going to abbreviate that, WIP, work in process. And the way to think about this is the factory. This is where the guitars are being manufactured. Any other business, this is where the product is being manufactured, assembled, whatever you want to call it. But the factory is where all of that is happening. Okay, so we're going to call that work in process. Work in process is where all the costs come together. Now, we'll come back to that in a minute. When the products are finished, then what happens is they're moved into the final inventory account, and that's what would be called the finished goods inventory. I'm just going to abbreviate that, FG, finished goods inventory, and we can think about that as the warehouse. Okay, so a warehouse would be another, again, separate building or separate part of the facility. It would not be part of the factory. It would be its own separate facility, and that's where all the goods that have been fully manufactured are now moved to. So we wouldn't keep all of our finished guitars sitting in the factory. They would be physically moved and placed in the warehouse. When somebody were to order guitars and they were shipped to, say, a retail store, music store, wherever that might be, then they would leave finished goods inventory, and then they would go to cost of goods sold. So that's really the flow. Of course, materials are coming into work in process as well here. So that's really the flow of costs through the inventory accounts. Eventually, the sold units are now going to be part of cost of goods sold. Okay? So one thing to also think about is the fact that we are going to have some additional costs coming in. All right, so we're going to have direct materials. We're going to have materials, but we're also going to have some other costs. We're going to have some labor costs, and we're going to have some other costs in the factory that are also going to become part of the product cost. Okay. So basically what we have is we have what's called manufacturing costs. And I'm just going to put that up here. So manufacturing costs are now equal to three costs. We're going to have direct costs, two costs for right now, direct costs, and indirect costs. Okay, manufacturing costs are all of the costs of the factory. So every cost at the factory level becomes part of the product cost. Okay, so there are no other costs that just become expenses. All of the costs at the factory become part of the product cost. So manufacturing costs are equal to what's called product costs. Product costs, move that over. So product cost include direct costs, and direct costs are going to be what's called direct materials. I'm going to just abbreviate that, direct materials and direct labor. Both of those are costs that can be directly traced to the product. So for instance, the actual wood, the strings, those would be direct materials. The people who are actually working on the guitars, assembling them, etc., their costs would be direct labor. Indirect costs, we're going to call factory overhead. And again, I'm going to abbreviate that. These are all the other costs at the factory. This would be depreciation, insurance, property taxes, cleaning supplies, the cafeteria costs. Every other cost that is not directly traceable is going to be called factory overhead. All three of these costs, though, are going to be part of the product costs. So we'll come back and finish this up in the next part.